I'll start by asking a question. Raise your hand if you're not feeling great about the current kind of state of the economy and the state of public policy. Raise your hand. Okay, I've got really good news for you. You're not going to feel worse after this session. I promise you. As we kind of went through the prep ahead of this, and first of all, thank you to Diane and Franchise Update Media and the IFA for bringing us back. I think this is a really great program, and I'm honored to lead it. I'm honored to shepherd it, because these two incredibly intelligent individuals are the ones who are going to really deliver the information. It was easy to kind of get bogged down into the kind of reality of what we're dealing with. And the truth is, the signal in what you're about to hear is that while there's still a lot of ambiguity about where we are and where we're going, and while on the surface level there's a lot to kind of dislike, there's also some really good indications that there are brighter days on the horizon. And what's critical for this group, and the reason why I agreed to do this when Diane asked 2 years ago, is I think it's really critical that as development leaders and as leaders in brands, that you're able to take this information, glean the best from it, and put it to use in your brands, and in the way that you lead your systems and your franchisees. So I'm honored to be here. Darrell, maybe just 2 seconds before we get into, you're going to kick us off. I see a lot of new faces in the room. We want to just give a quick intro, and then Matt, maybe same, just a quick intro, so folks know who they're talking to.
Sure. I'm Darrell Johnson with Fran Data. We're a research company. We're a research and analytics advisory company. We focus entirely on franchising and have been doing this for about 35 years now. So we've been tracking the franchise business model, analyzing it, and trying to understand and stay in front of a lot of the things that are happening in franchising and advising on where we think things are going. So that's what you're going to get from me today.
Great. Matt?
Yeah, Matt Haller, President and CEO of the International Franchise Association. I like country music. I like 70s and 80s classic rock music, and I was the guy dancing on the tables in college, but there's no video of that because it was in the pre-video era. And I aspire to have hair as good as John Teza.
Getting grayer and grayer by the day. And I'm John Teza. I'm the CEO of Hand & Stone. We're a 660-unit spa, massage and facial spa franchise across the US and Canada. We are private equity held. We're in our second private equity partner. We've been private equity held for the last 10 years, and so we've been around the block on that. And I've been in multi-site consumer and franchising for my entire now 28-year career, and across a bunch of different domains. And I can, without question, say that I have never been, we've never operated in a more interesting time. And let's get into it. So Darrell, you're gonna kick us off. You've got a great presentation. Why don't you get us going?
All right, thanks, John. I usually, for those of you who've seen me make presentations, I usually move around the stage, and I think today it might be a little safer for me personally if I do, but I'll stay seated. To start, the economy is doing okay. And that's all I'm going to say about that. Let's get into what we really think. Let's put things in perspective first. The U.S. in the context of the world. The economic balloon across the world is losing air. It's slowing down, but it's still up in the air. And as you can see from the numbers, the world economy is estimated to decline the GDP about 0.5% this year. The U.S. economy, more like 1%. So it's slowing down at a relatively faster rate than the rest of the world. That's neither good nor bad in the context overall, but generally the U.S. is one of the engines that keeps the world economy chugging along. So with the U.S. slowing down, it does have potential implications to the near-term growth forecast. What I'm going to talk about here in the next few slides. And there's only about 8 or 10 of them that we narrowed it down to. But what I want to show you is to quote Edwards Deming, the great industrial consultant in the earliest part of the 20th century. Without data, we're just people with opinions. So we want to look at what the data is telling us and see where we're at. What are the trends showing of kind of near-term trends that are getting us to where we are today? And where are we today? So we have some idea of what is, at least in the near term, and as we look to 2026, many of you are setting budgets. Over half of you haven't set your sales budget for 2026. So what are you going to base that on? Well, let's see if we can see some things here that might be useful to you in looking at what we are confronting and where the economy is today and where franchising is today. First of all, there's that dichotomy between the stock market and small business. And we all know it. And small business optimism has been on a decline now for the last couple of years. It seems inconsistent with what larger companies in the stock market overall are doing. We don't have time today to go into why, but that's happening, and it's a factor that we have to dig into a little more deeply. And one aspect of it, if we look at just the impact on franchising of events, the government shutdown, by and large, doesn't affect large businesses. The stock market hasn't gone down. But in the franchise business model, there's a direct impact. And this goes back to the previous slide of how small businesses are more sensitive to changes that are going on in the economy. The shocks that happen throughout the year impact franchising to a greater degree as part of the small business community. And as we look at here, Frandata did some analysis of the impact that just on a daily basis, how the government shutdown is going to affect franchising. Well, $25 million a day in the large business community is not even a rounding error. But in franchising, that represents 70 or 80 franchised units that are not getting financed. Now, if it lasts a few days, not so much of a problem. If it lasts a few weeks, much bigger problem. So those kinds of shocks affect the small business community, and franchising in particular, much more directly. We all know what kind of the labor situation is in the country. The September numbers weren't published because the government isn't publishing them currently. The Carlyle Group estimated the number of new jobs created in September at about 17,000. The consensus among economists was about 34,000. Those are really small numbers. Clearly, we are in a slow period. We're not in a period where there's much job creation at all. And if that's happening, the byproduct of that, we're seeing very little labor turnover. People aren't moving. And so it's not by itself a major concern, but it's another indicator of just that air starting to come out of the balloon, the economy slowing down. And then the question is, well, what's there that's going to push the economy back up again? Well,
Darrell, good article in the Journal today about not just Carlyle, but several private employers, large private employers, and in the absence of a BLS official statistic, it does appear kind of coalescing around that 17 to 20,000. Go back to that slide for a second. We hear a lot about the velocity in the labor market, and that the velocity is declining, meaning people are leaving jobs less frequently. Mm-hmm. We know that this job market has been punishing on those without a job. What does that do to wages? What's the impact been from that kind of the deceleration of the velocity of the market, and what's that do to wages?
Well, when people change jobs, I think the most recent numbers that I've seen is that when people move from one job to another, they have about a 6% increase in wages, and when compared to people that stay in current jobs, which is closer to about 4% increase in wages. So there is a slight increase in wages, but what we're seeing across the board, and I'm sure most of you are experiencing, the wage pressure is off. And that will be reflected in a slide a few slides from now that will show from a franchisor survey standpoint how much of a concern wages are and what's changing in the context of what is worrying them.
Yeah, we'll talk about the implications on discretionary income and spending in a couple of slides. I just wanted to highlight that this is another one of those factors that's below the surface.
Yeah.
That we're not, we know that wages have stagnated, particularly kind of over the last 2 years in particular, wages have stagnated after a period of significant growth. There's a compound impact from this deceleration of the
That's right. That's right. These are all indicators. These are byproducts of what's going on in the economy, and we're trying to help frame the discussion that we're about to have and saying, if these are the things that we're confronting, then what do we do about it? But this is yet another factor. One other one that I would point to as a typical leading indicator of how the economy overall is doing is that if we look at delinquency rates over a period of time, and this, for those of you who can't read it, it's mortgage, it's credit cards, it's student debt, it's auto loans. If we look at the trends there, the one that is concerning to me as I look at this is credit card debt, because if we have a big rise in credit card debt, as we have in the past, in the early 2000s when we had credit card debt really rising, it was one of the things that exacerbated the great financial crisis. When credit card debt gets up to a certain capacity and you start seeing delinquencies rising considerably, that stress combined with what we just talked about with wages creates a real downward pressure on economic activity. And we're starting to see that. It's reflected, as we'll talk about in a little bit, about pricing flexibility and the ability of businesses to increase prices in this kind of environment. This is one of the reasons that you can't. They're sort of stressed out. The student loan pop, for those of you that I'm sure most of you know, that there was a moratorium until October of 24. So a year ago, up until a year ago, there was a moratorium on repayment, and then once that kicked in, it naturally jumped up. What's important on that one is student loans really affect a large segment of our economy right now. And it isn't that it jumped up, it's how high it jumped that matters there. If you look at the trend line of year over year on student loan delinquencies, it was kind of bumping along. Well, this one, it jumped up, and that's another indicator of real stress going on in that segment of the economy.
It was like somebody told them that they could just stop paying on their loans.
Yeah, are you suggesting that Trump should just forgive them?
Now, Darrell, quick question on that. We've heard a lot about the Fed cutting the headline rate. We just saw a quarter-point decrease. Some estimates are as much as a full point between now and the end of the year. Is that enough to start to reverse some of these trends, or at least to positively impact them?
Well, I think a couple other slides may give a little better foundation from which we can talk about that. So let me defer the response to that for a little bit. But if I try and dodge it later, come back at me. You're much bigger than I am. You can pin me down.
Yeah, but you're faster.
Consumer spending and sentiment. Something that we all hear, that we all come out every month, we pay attention to them, we see what's happening. I will mention a little later why I have a little bit of skepticism about what some of this is telling us. But I think if you compare that to how consumer spending is actually being done and then what sentiment is doing, I think you have a better combined picture that are not in the sentiment side influenced by other factors these days. And I think what we're seeing in this case, again, this is not a crashing economy, but it's an economy that's slowing down. And these are other indicators and byproducts of things that are going on that are reflected. If consumer spending, if that balloon is losing altitude but still staying up in the air, it means there is some expansion, but that expansion doesn't give you a lot of latitude for price increases. It's not that rising tide that we used to see. Didn't know we did it that way. Unit growth rates. We took a different approach to analyzing this, and thanks for AI and our increasing ability from a research standpoint to analyze data on a brand-by-brand basis as opposed to just looking at it in aggregate. So we looked at the actual unit growth percentage growth by brand over the last few years. And this reflects the very thing that we've been talking about in the last few slides. It's slowing. It's growing, but it's slowing. And another indicator, another factor in where we are with the economy today.
For the CEOs and CFOs in the room, I'm sorry for what I'm about to say, but for the development leaders in the room, you need to take this back to your CEOs, and you need to take this to your boards, right? This is the reality, and then every brand is going to be a little bit different, and every brand offering is going to be more aligned or less aligned for growth in this period. But this is the reality, and unless you've got something very unique about your particular offering or your particular brand or your particular snow pipeline or your ability to finance the development or to create capabilities for your franchisees to finance the development of new units, this is the reality. And your plans need to reflect that. And which means your CEOs, like me, need to have the tough conversations with their boards about what expectations look like in the next 12 to 24 months.
One of the other things we look at from an analytical standpoint is an indicator of stress. Now, there can be a lot of different reasons that this can happen, but if we look at transfer activity, and we did the same thing here where we looked at it on a brand-by-brand basis as opposed to just looking at the aggregate year-end numbers. And this trend line, while it doesn't look much different than it did a couple of years ago, it's being driven by different things today. We have seen increases in transfers pop up after a financial crisis or after a crisis of some sort, COVID the same way, where franchisors looked at underperformers and said, we got to do something about the underperformers, and took actions. Well, that's not happening now. We also have seen it during a period where there's very low interest rates, when larger operators buy smaller operators, where the economics from a buy versus build standpoint start favoring buy. So we see it then. And that's not happening. So something else is going on here when we start seeing an increase in transfers that we need to look at more carefully, and as franchisors need to pay more attention to.
This is actually one I think that is a silver lining for the environment that we're in. These periods where we see an increase in the amount of transfers can be an opportunity for you to create healthy consolidation within your system, or to create an environment where there's new blood coming into the system where some of your operators may have kind of run their course. And so this, and as you think about what I just last said about the implications on new unit development, this is an area that you and your team should be leaning hard into, making sure that you have the right support for the transactions, but more importantly, making sure that you have the right support for post-transfer, post-transaction success. I can tell you without question, I got a couple people from my team in the room, we're leaning heavily into this. And in particular, making sure that we are enhancing our ability to support, train, and provide the right marketing support when units do change hands.
But wait, there's more. Are we having fun yet?
This slide is fascinating. I will tell you, you were talking about taking this slide out. This slide is fascinating.
Yeah. Well, this is the IFA does an annual survey of franchisors, and they do an annual survey of franchisees. And we've been doing it enough years now where we have some meaningful trend lines and great guidance that's coming out of this. And to be clear, what this slide represents is what is top of mind concerns that are keeping franchisor management teams up at night. And as you can see from 22 to 25, there's been a fair amount of movement on these slides. There's two that I would draw your attention to in particular. The first one, and the more relevant one, I think from the standpoint of where we are today, is poor sales. Coming out of the COVID crisis, where there was pricing flexibility as well as consumer enthusiasm, poor sales was generally not much of a radar issue for franchisors. And that was true in 2023. In 2024, it started to become an increasing issue because the pricing flexibility started to go away. At the same time, consumer optimism started waning. And here we are in 2025, and we're seeing it being almost top of the concerns for franchisors. We looked at, on a brand-by-brand basis for about close to 2,000 brands, how their average unit revenues have changed from one year to the next. Again, having new technology enables a lot of things that we were not able to do previously. But when we looked at that, what it showed us was rather surprising. We saw a decline from 2024 to 2025 in average unit revenues of 5.2% across the board. That's a big number. And if that's happening at a time where we're seeing inflationary pressures, which is coming in the operating side of things, that's undoubtedly what's leading franchisor management teams to say this is top of mind and a big concern to us.
Yeah, what I love about this slide, there's a couple things in Darrell's point about sort of the natural organic pressure on demand, right, is really clear. And we're going to continue to talk about all the what's causing that. But what I love about this slide is how intuitive how intuitive the takeaway is here, which is, as you think about, we're going to see in a second on another slide, is that four-wall profitability has improved on a unit-by-unit basis. We're certainly seeing that. A big driver of that is increase in revenue related to price increases. This slide shows unequivocally the impact of all of us taking price, right? So where cost of labor is going down, right? And concern about cost of labor is going down because we've taken revenue related to price. It's really sort of naturally accretive to EBITDA, right? At the same time, we've seen an impact on sales, right? Concerns about poor sales, and particularly sales related to traffic, has skyrocketed from 22 to 25. Right, so we've all created a little bit more effective four-wall operating environments by passing cost pressures onto the consumer, but it's come at a price, and that price is traffic. And the implications of that are showing up in our inability to continue to grow top-line revenue. And so what's the implication, right? What do you take back to your teams? You've got to be really sober about the way that you're thinking about taking price at the unit level, because the implications are real as it relates to your ability to build traffic, which builds long-term health in your four-wall operating model.
One other thing I'd mention is that, as you can see, when you have inflation being a much bigger concern in the minds of management teams, at the same time, the poor sales is even a bigger concern. That's a double whammy, and we're going to talk about this. What do you do? What are the implications of that from an operating standpoint, from a growth standpoint? Most of you are in the development side, so what do you do about that? How do we handle that? This last slide is aimed at the franchisors in the room, and it is really intended to say, with all the things that are going on that we just presented, both in terms of the general economy and how franchising is doing within that framework, what is the capacity and, in a sense, what is the ability of franchisors to react to it? And so what we did is the same kind of analysis that we had done on the previous couple slides, which is to look at thousands of franchise brands, look at what their operating profit margins are, as a way of looking at their ability to invest more at a time when they're seeing declining same-store sales, increase in pressure on franchised unit economics, and a more challenging environment to find qualified franchisees. So are they in a position, because of how they've been building their businesses, to be able to invest more in it? And what this shows is we've been on a relatively steady declining. In 23, it was a bit of an anomaly there, but it was a catch-up from the COVID crisis. But in 2024 at 15%, and we're seeing so far year-to-date in 2025, that's actually going down again. So we're at a time when franchisors are needing to do more, are they in an ability to do more, is starting to be tighter, and that creates a conundrum for sure.
Yep.
If I were to summarize everything that I just depressed you with, I would
say those of you, raise your hand if you were feeling bad. You don't feel any worse, right? Kind of feel the way you felt when we started.
Just for the record, I'm the messenger here. My research team put these slides together, so I just want to be clear on that, right? Okay. If I were to summarize it, I would say this. We're in an environment where we are not able to easily raise prices across the board. Now, this isn't just about franchising. This isn't just about your sector or your business within the overall economy, but it's true across the economy as a whole. Both the consumer appetite for absorbing increased pricing at a time when we're having more inflation just isn't there, because the wage pressure is down. It's compressing it. And that creates a real imbalance and a real challenge. Declining unit ROIs, well, of course, with all of this going on, we should expect that. Franchisor budgets we just talked about, and slowing unit growth rates. Well, from a budget standpoint, whether it's emerging growth, mature brands, as John mentioned, and as I think the data would suggest, being very thoughtful about how you plan on growing in the next 12 months is important because of the environment you're confronted with. One of the things that it leads to is we've seen a lot more optimization across the board, both at the franchisor and the franchisee level, and a lot more product innovation, and we'll touch a little bit on that when we chat in a few minutes. But we're seeing a big turn towards that. The one thing I would put as a cautionary note on that is that with all of the emphasis on AI and how many brands are spending money and how many businesses are spending money on AI, as we're finding now after a couple of years of experimenting with it, it's more costly, and the return on that takes much longer to realize. And that goes back to the franchisor overall margins, and are they able to continue to fund that at a time when the near-term needs within their systems are greater? And not to miss the capital side of things, lending standards are tighter. We have some lenders in the room. I'm sure that you would like to chat with them, and they'd like you to chat with them about how their lending standards are much more liberal than their competitors. But the fact is overall that we're seeing tighter lending standards. And of course, interest rates are not seemingly going down. I think we're seeing quite the opposite, even though the Fed has dropped a quarter point and may continue to do so. I think the bond market will be the determinant as to whether that's a good idea or not.
Yep. So we're going to transition to Matt in a second, but maybe one or two questions for you, Darrell. The one thing that I think in the economic data that has been a bit encouraging is that we have not started to see kind of the runaway inflation that was kind of the knock on the current administration's trade policies, that we were going to see kind of a return to runaway inflation. You have a perspective on that and kind of where that might go over the next, over the short term?
Are you referring primarily to tariffs?
Yeah, well, just in general, kind of the headline inflation rate and whether what's likely in terms of where that goes from here.
Well, just to speak to the tariffs for a moment, tariff is only on durable goods. We're primarily a service-driven economy, so the tariffs by themselves did not have a big impact on trade policy or on the economy as a result of the trade policy, and that's the one that's sort of front and center of that's been held out as the primary concern about the administration's efforts across the board on trade policy. So that by itself, it's inflationary to be sure. It's a cost that has to be absorbed, whether it's by the company or by the consumer or both. It's a real cost, but it's only on durable goods, so it's not impacting everything. The broader concern is that we're seeing inflation almost across the board. The forecast that just came out from the New York Fed, that in September, their consumer economic forecast was that was an expectation that inflation is going to rise to be as high as 3.2 to 3.4% in the coming year. It actually went up from 3.2 to 3.4% in their district consumer survey. So the expectation across the board, and when you get expectations that are fairly deep-seated, they tend to help drive reality in the near term. So I think what we're seeing is a rise in inflation irrespective of trade policy specifically, but that's an add-on impact that is just perhaps exacerbating it.
Yeah, fortunately for the last 12 months or so, there's been a spread, though, between kind of the forecast rate and where the rate has come in.
Yeah.
Around 50 basis points.
Yeah, we're currently running at about 2.7%, which is still above the Fed's 2% target. And 2.7 is certainly better than what the consumer expectations of the next 12 months are, of 3.4%. So yes, we've been running underneath that.
Yep. Before we pass it on to Matt, I'll just say from a business and a planning implication, the stance that we're taking, and this is true, I think, as I think about the other brands in the Harvest portfolio or in the portfolio of a couple of other board members, we're in a tough spot, right? There's no debating that. Darrell has just presented that view. The light on the horizon for me is, and what we're seeing across this broader brand set is, there's no question discretionary income has been impaired, right? Wages have stagnated over the last 24 months. Energy, housing, transportation, labor, food, right? Those costs have all gone up. And so there's definitely a discretionary spending implication to that, and we've felt it. But it feels like there are some potential improvements on the horizon. The tax cuts will have, the interest rate cuts will have a real positive implication, particularly around things like credit card debt and student loans, variable rate mortgages, right? That will hopefully free up a little bit of discretionary spending. The sort of future codification of the tax cuts come the first of the year, super helpful, particularly in the Northeast, where the SALT tax rollback has a real impact. I mean, that'll put real money back in the pockets of consumers. And so, the reason I ask about inflation, that is the one thing that, as long as that stays relatively level or consistent with current levels, heading into 2026, I'm not sure the macro economy improves, but our assumption is that discretionary spending for our part, we're a middle market consumer brand, and a lot of the brands that we have exposure to are also middle market consumer brands, that there's going to be some relief there, and that we should start to see some improvement in spending there. So I think very difficult current landscape, and unfortunately the jobs data is not necessarily helping that right now, but definitely looking ahead to what could be a better year in 2026. So let's connect the dots. I'm going to ask you one more question before I pass it off to Matt, because this is something I'm going to ask of both of you. We're in a really unique environment. How is the public policy environment impacting sentiment on the economy?
John, I'll let Matt answer that first.
Well, I'm going to come back, because I'm going to ask Matt the same question. How is the economy impacting public policy? But let's turn it over to Matt for now.
Massively. I think there's probably never been a greater amount of Americans dialed in to what is happening at 1600 Pennsylvania Avenue. And I think that is having massive ramifications, in the mindset. You look at all the data. I think about more the political mood and just Trump has it's dialed everything up, right? Everything is at a fever pitch. It's everything everywhere all at once. If you, to quote Bruce Melman, who spoke at the IFA convention in February, and I think that has a real impact on people's ability to make decisions, whether it's buying a franchise or subscribing to your Hand and Stone franchisees membership. I mean, I think it's everything. But I will say, think about all the crap we were talking about last year when we all sat here. Okay, so you have to put life into context, right? And it's my job to also not be as Debbie Downer as Darrell is, and bring us back at the end of the conversation here, because there is hope. Let me tell you all, there is great hope, right? And I said, for those that were at IFPG last week, it was great to see many of you there. I'd still rather be us than them. Right? I'd still rather be in franchising than not be in franchising.
Absolutely.
Because look at COVID. Look at what we did together as a community to bootstrap and through grit and relationships that got stronger, not weaker, coming out of that. And then look at the data that Darrell just presented. I believe that we will come out of this period stronger than we were going into it.
Yeah.
And I think, thinking about what is IFA doing to fix all the stuff that, Darrell laid out, which is all very good and accurate, we still have opportunity. We have opportunity to take advantage of a moment in time, this Congress, and get rid of some of the things that have been plaguing us on the regulatory side for over a decade. So I'll talk a little bit about the joint employer issue in a second, but to do all of that, you got to start with, what does the public think about franchising, right? Consumers still think that franchising is big business, and policymakers, for those that have been to Washington, they need to be reminded that franchising is small business, and that is our job. And if you look at Gen Z, that number is astonishing. There's 77% think of these are brands, and those who manifest the brand's reality at the local level as big business. So this is all data from Morning Consult that we did in June of 2025. So our job is to go on offense. It's to go on offense with our narrative, what our narrative really is. Franchising is small business. Franchising supports communities. Franchising is much more diverse than just fast food. And change the public's perception about this so that we can also change policy at a time where we have this opportunity to do so. So yesterday, IFA, with significant contributions from our IFA Foundation, our 501c3 entity, we launched a new campaign, Franchise Means Local. And that's what we're going to be communicating over the next 3 years. This is a $5 million effort to start, and this is all about getting real stories of franchisees out there in the public domain on the platforms that consumers actually consume content. This is platform native. This isn't, driving leads to franchise development, although I think that if you want to participate in this campaign with us and leverage your brands, there's certainly ways to help us and help you do what everybody in this room wants to do, which is, increase those numbers of new store openings that we all need to drive brand growth. Let me just play what is one of the first waves of content that is already rolling out, and then I'll talk through a little bit more of the details of the campaign. So this is Clement Troutman, a Navy veteran who became a Tropical Smoothie Cafe franchisee. His daughters are also running this business with me. His story is exactly the story that exists in every single brand in most states across this country, and it's exactly what we need lawmakers and the public to understand and appreciate to change the perception that franchise means local.
People see a logo, I see my story. A Navy veteran, a dad, a small business owner. Behind every smoothie is a mission to build something, to create jobs, to serve my neighbors. This isn't corporate, it's community. It's not just Tropical Smoothie Cafe, it's my Tropical Smoothie Cafe.
Well done.
I mean, it just hits you right here, right? You can't, it's sort of like the conversation this morning. It's real, it's raw, it's emotional, and that's what we need to be doing, right? We need to be getting these stories out there on all sorts of platforms. So, John, I want to thank you for Lauren, Toya, and Chanel's small business that you've put into, well, maybe Jennifer did this, but you had a small one.
Yeah.
There's some great stories. So these will be, ads that are running on Facebook, Instagram, TikTok, and these are importantly in key states, right? As I'll get to in just a minute here about our political and legislative strategy. So we want your stories to be part of the franchise story and the story that we're going to communicate over the coming years as part of this. So we've been working with Kraft, which is our public affairs vendor, and Fishman, who's helping us with some of this work to develop a toolkit for the industry to make this as easy as possible for you to get us the stories that you have, the content. Not everything is going to be as high production as the tropical smoothie story there, but we want this to be real stories about what franchising means in the communities, what it means for employees, and this is how we're going to change the public's perception. So my hope is that next year when I'm sitting up here with you guys, assuming that, well, I guess it is sort of up to me who we put on stage.
Yeah, it is now. It is now.
But if I will have us back, if we do our job successfully and the data comes in that this was a good program, we'll be delivering progress on this because we're benchmarking our performance of this campaign as we get into this in the next 6 months. And hopefully we're also delivering a significant legislative victory as well. So there's a QR code there, there's a social toolkit, and there's a way to get in touch with the team, and we'll follow up with you and your marketing communications teams or your firms to get you participating in this.
Matt, what I might add here is that every brand in the room has a feel-good franchisee story that could be put into this. And think of the marketing benefit you're getting from it. Yeah. Come on, reach out. This is actually a very useful thing, not just for you, for your brand, but it's very important in what Matt's team does. And also just for the franchise business model, that's a message that we need out there. And we can do it. Every one of you has one.
Okay, so what are we going to do to change the law? So who here has heard so far about the American Franchise Act? How well is our marketing team doing? We're crushing it. Okay, good. So if you haven't heard about what it is, this is, we've had 10 years of the joint employer issue. It's gone back and forth from Obama to Trump to Biden, back to Trump. So we have good regulatory policy right now, but that is fleeting, right? We know there will be a future change in administration. We know if that happens, it would likely, get changed again. There's various court rulings that are conflicting in this space. What we need is durable statutory change. Previous efforts on the Hill, things like the Save Local Business Act, have tried to address the joint employer issue for all business-to-business relationships, including franchising. So whether you're a Boeing or your Hand and Stone Massage, it's tried to cobble together the same solution. The problem with that approach is it invites a very large political constituency opposed to that effort, primarily in organized labor. And I talk about these NASCAR letters. So a NASCAR letter, business groups, send letters with our logo and the Restaurant Association logo and the Retail Federation logo, and we support things. And the labor unions send, their NASCAR letters of AFL-CIO and the Teamsters and the building trades and blah, 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 blah. Well, what we've done with the American Franchise Act is we've whittled down the solution to just the franchisor-franchisee relationship. And this approach does two things. One, it has created a lot more bipartisan support for this issue because we've been told for a decade, well, Republicans and Democrats, we want to support franchising and we do support franchising, but these attempts to address this issue just go too far, and I'm hearing too much opposition from organized labor. Secondly, the Republican Party has been changing, and the Republican Party is now much more populist. The coalition that President Trump built and put him back into the office includes lots of building trade unions. Well, building trade unions aren't really focused on the franchisor-franchisee relationship. That's the service sector unions. So the unions that opposed previous attempts to the joint employer issue are not all going to oppose the American Franchise Act. So that's helped us build a significant amount of bipartisan support at the bill's introduction. That's a huge game changer in this approach, and something that we need to capitalize on. So for those that were in DC for our advocacy summit 3 weeks ago now, the bill was introduced just before that, 7 Republicans and 7 Democrats. We're now up to 30 bipartisan co-sponsors. I believe we have 11 Democrats on the bill now. Congress.gov is not even being updated because the government shut down. So the team tells me as of this morning we have several more that are going to get on this bill. But this map right here, so take a picture of this slide. This is the next wave of those who need to support the American Franchise Act. And these targets are all on the Democratic side. Right? We want to continue to build as much Democratic support for this issue as possible. And since I know most don't know where Oklahoma 2 is, we took the liberty of adding the major cities and DMAs for the House members on this next slide here. So if you have franchisees that can be activated through the IFA's campaign, I would love to get them involved in this. The story that we're telling, which I will play on this next short video here, if I may, John, is really something that is helping us get the message out beyond the direct-to-direct lawmaker to franchisee and franchisor communication with a significant amount of advertising through IFA's affiliated 501c4 political vehicle, which can expressly advocate for this legislation, and it can even name lawmakers in our advertising. So the foundation campaign is essentially the air cover, at the 30,000 foot, building affinity for the franchise business model through powerful storytelling, like Clement's video. This campaign, these advertisements, which will happen in those districts and states of those target members, will make the case for why we need the American Franchise Act.
Your local gym, your favorite restaurant, your trusted salon. They're franchises, small businesses creating jobs and opportunities in every corner of America. Franchising is a pathway to prosperity for underrepresented communities, women, people of color, veterans. Yet local franchises are at risk with shifting rules stifling growth. But Congress can fix it. Support the American Franchise Act, protect small businesses, and keep entrepreneurship alive. Visit SaveLocalBusinesses.com to learn more.
Thank you. So we need your support in this. We need your support with boots on the ground and franchisee engagement, particularly in those states. We need the support with resources to continue to be members of the IFA. If you can spare it, we have this coalition to save local business, which you can make a corporate contribution to. Contributions can be unlimited. They are anonymous. We have a tool for those that own many of your brands, private equity companies who have been supporting this in a lot of ways. So feel free to reach out to me directly if there's a way you can get involved. We have a real chance to get this done in the next 18 months. And I can't overstate that enough, that as Morrison said this morning, opportunity is not given to you. It has to be seized, and that's exactly what we're doing on your behalf this Congress.
Hey, Matt, can I ask you, I want to put you on the spot and ask you a follow-up that we didn't talk about. For the benefit of this room, what are 2 or 3 real meaningful implications of either being deemed a joint employer or not being deemed a joint employer? Like, why does this room need to take back to their brands why this is so important?
Well, the development people in this room, you want your new owners to be set up for success, and you need the brand to be able to invest, right? Darrell talked in his slide about the pullback in franchisor support of franchisees. That's a real concern to the actual value proposition of the franchise business model, right? We're in business for ourselves, but not by ourselves. Having a broader joint employer rule in place cuts at the very heart of our ability to deliver the value proposition that a franchisee has paid you an initial franchise fee and ongoing royalties and other fees to support them with. And if you can't, as a brand, provide that training to
right.
the managers of your Hand and Stone Massage to deliver that the customer experience at the local level, particularly for new owners,
right.
they're going to be less likely to be successful.
Right.
And as we also heard, the best validators of your FranDev opportunity are your existing franchisees. So this is about providing support to franchisees,
yep.
and then preserving the equity in the franchisee's business and increasing the valuation of the franchisor
yeah.
for yourself or for your owners. So those are some of the real world implications of why this is so important to get done. Not to say nothing of the cost of all the litigation that joint employer has created. There's a cottage industry of plaintiffs' attorneys now that just name the franchisor in every suit that's brought against a franchise at a franchisee location. Why wouldn't you do that, right? You're going to get a much more higher settlement. And if the American Franchise Act becomes law, it's going to give franchisors and your councils a great tool to get those cases dismissed at an initial stage rather than having to litigate it to an appellate stage.
Yeah, and look, in an extreme enough position, there's actually less of an incentive to franchise, right? Because if I'm going to be subject to pass-through liability, I can tell you in my business, if I'm going to be subject to pass-through liability all the way down to the unit level and all the way down to the individual practitioner level, there's way less of an incentive to franchise, right? Yeah. Those are potential risks that, if we want to grow the brand, we'll grow it in a different way.
Yeah, we've called it the corporate takeover of Main Street,
yeah.
right? I mean, if you take joint employer to its full conclusion, it eliminates the value proposition of franchise. It makes if you franchise at all, it's likely going to mean you're looking at bigger franchisees. And while we know that's the trend due to lots of macroeconomic factors, at the end of the day, most franchisees still own less than 5 locations, and that's the story back to franchise means local that we need to preserve and protect.
Yep. So we've got about 10 minutes left, and I want to allow time for questions and some final thoughts. I have one more question for you. In a couple of minutes, and this is probably loaded, probably impossible to do, you occupy a place that none of us occupy, right? You have access to some perspective on what's going on from a policy standpoint and an agenda standpoint. What are 1 or 2 things that you can share with this group from a policy perspective that you think we would need to know?
Yeah, I think this administration, they laid out a case for what they were going to do in this 4-year term, and they're working right down that playbook. So whether it's trade and the tariff issues that Darrell touched on some of the impact there, or the immigration issues that we talked about a little bit yesterday, these have real world implications, obviously in franchising. I think IFA does have access, and we have a very good working relationship with this administration. But the way to affect outcomes in this administration, and Congress has essentially become more of an afterthought, unfortunately, is not through public criticism. It's through private understanding of the impact that it's going to have on this administration's ability to deliver what they call a golden age of economic growth. And what they would hope is that the second term of the Trump administration is paving the way for a J.D. Vance administration. Mm-hmm. The whole theory of the case, though, was built on an economic agenda that was different than what while Harris, I don't think, did a good job laying out a case for why she should be there. The whole theory of the case was voters trust us more on the economy than the Democrats. And the reality, except for the upper income, stock market and kind of millionaire, billionaire class, is that's not the reality. And that is something that they understand when you talk to them privately, that we're struggling, right? And you need us, and you need our consumers, and you need our small business owners to be successful. And some of these policy implications around immigration and around trade are having a real impact.
Yeah. So suffice it to say, it's kind of what you see is what you get, right?
Yeah.
What they said they were going to do, they're on a path to doing, and they'll, like, if you look at Doge, for example, right? That was a marquee, call it initiative, right? Strategic objective that proved to be less successful than they had hoped, and they pivoted, right? They kind of.
But they will change, right? They will, Trump is much more interested in the press release than he is in the policy, right, on most issues. Mm-hmm. So if he can create the perception that he's delivering what he promised on the campaign. Look at no tax on tips. I mean, great policy for a lot of franchisors and franchisees and employees, but it's not permanent, right? Like, we're going to be litigating this again in a couple years. Yep. So why getting some of the things in the tax law permanent were, around 199A and some of the other policies, bonus depreciation, interest deductibility, those were huge. Those are permanent. They're going to be a lot harder for anybody to ever undo.
Yeah.
Right. Good. So we've got a couple minutes for questions. You got two. I think. Do we have any microphones around? If not, just holler.
Robin, you can just holler.
Yeah.
One of our fiercest advocates for IFA and the work we do. So I appreciate you and Eric and what you guys have done. Thank you for your many thousands of dollars of contributions to not only the PAC, but also, I believe, a $25,000 contribution to the Coalition to Save Local Business. So thank you for that. And if anybody's willing to do anything either this year or build into their budget for next year, please consider that. Yeah, so the question is, how does all the redistricting that's happening in various red and blue states impact our ability to get policy done in Congress? I think it's more likely than not that, if history is a guide, that the sitting president will lose seats in the House during the first midterm election. So it's very likely that the Trump administration is, dealing with the Democratic House, which is why they're driving so many of the Republican states to do early redistricting. In response, the Democrats in states like California and New York are attempting to, add more blue seats in blue states. I think it just reinforces the urgency of getting it done this Congress. And the window, while it is the full Congress, the full term through 2026, even into the lame duck that could exist in December of next year, the reality is the window is probably until the end of July. Because then you get into the election and silly season, and there's very little opportunity to legislate. And then I think, it's very hard to predict how all this shakes out right now, because there will be, legal challenges in most of those states to the redistricting efforts. At the end of the day, though, even if the Democrats do prevail, it's one of the other reasons why having a bipartisan approach to everything that we do at IFA is paramount, because we need to be, at the table, not on the menu with whoever's in charge in the administration or in Congress.
Yep. Final questions? Final thoughts? You got any?
The economy's okay. I want to be clear.
Look, I'll say what I said to open things up this morning. Thank you for being here, for investing in yourselves, because you'll walk out of this event, stronger. We're all in this together. It's one of the things that I think is so great about franchising is, we have these incredible assets in the relationships that are built across, some of the, fiercest competitors, but we're all, in it to make franchising stronger from within at events like this, and stronger on the outside with changing policy and public perception of what we do. So thank you for being involved in this event. Thank you for being IFA members, and thank you for getting involved in these campaigns to help us make long-lasting and durable change.
All right, thank you, guys. Darrell.
John, thank you so
Matt.
much.
Thank you. Great job. Great
Well done.
as always.